is that the exit comps have changed. If you were a tech investor, or let's say a real estate investor, before the regime change, you were underwriting to a completely different exit comp. And now those exit comps have totally changed. And so it's going to be very hard for those investors to make a good return.
So they're going to lose their money like Instacart. Yeah.
I'll give you a mathematical example just to illustrate what David just said. If you have a company with 300 million of ARR, you are in a rare group of, say, 30 or 40 companies, period. Okay? So very, very, very few companies get to that level of scale. But if you are at 100% net dollar retention, okay, which means that you're kind of treading water, essentially. Your customers may grow, but the value of each customer isn't particularly growing. So you have pretty nominal growth. That company now comps to roughly 3 to 5 times ARR. Now, the problem is if you go and look back through Crunchbase or any of these other PitchBook, the number of companies that traded above $1.5 billion valuation as a SaaS business, there's like 70 of them, but there's only 7 of them that have 300 million of ARR. So what happens, guys? Like the jig is up. Okay. What's going on here?
Consolidation, I guess, and some of them will flame out. I mean, look at Instacart. The people who were the last 4 rounds, they either lost money or broke even. So, and that means time adjusted versus what they could have made in the markets. They lost money. So,
what happens if Stripe is only worth 30?
I mean, how much has been invested into that company? What's the total paid in capital?
Again,
that's the question.
I think we all want Stripe to be worth 100. We want it to be worth 200 billion because it would help. Frankly, it is the rising tide that lifts all boats. But if unit level profitability is scrutinized and then comped appropriately to the public markets, as Zach said, we're going to have to take that signal and apply it to our entire portfolio. And so it goes all the way back to eventually the seed and the Series A as well, which is really good, Jason, as you've said many times, just getting the inflation under control and in check. But it will mean not just changing valuations, but it will mean changing salaries, right? It will mean totally different equity packages.
A lot of hard work. Yeah.
I almost think that maybe none of the hard work has actually yet started. So I don't know. I'm just putting that out there, guys. Do you think that we've all just kind of been hoping maybe that all of this would pass? And now we're getting more and more signals that we actually have to do a pretty hard valuation reset?
Yeah, I mean, if you look at the altimeter charts that Jam Ball has put out, I mean, the valuation levels are returning to, let's call it the pre-COVID mean. In fact, they're slightly below the pre-COVID mean because the 10-year Treasury has a higher rate. So, yeah, we're going back to something that was more like, 2015 levels of valuation, and maybe even slightly worse, again, because long-term rates are higher. So cost of capital and hurdle rate are higher.
That's what I'm saying. I'm seeing 2012 valuations. Valuation of Uber when I invested was $5 million.
Yeah, let me just tell you, it's a lot harder for people to make money when the money supply is shrinking than when the money supply is growing. For obvious reasons. Figure. When the money supply is shrinking, it's like you're playing a game of musical chairs. And you're just hoping that you still have a seat. Whereas when the pie is increasing, it's a lot easier to get like a piece of it. But when the pie is shrinking, it's a lot harder to get a piece.
Musical chairs, as you described it, is literally the description of the venture capital industry and GPs right now. A lot of people are losing their seats.
Yeah.
And I think there's going to be a lot of shutdowns of venture firms. I think a lot of venture firms are going to shut down. There's going to be zombie funds.
I think we got to believe the extraordinary outcomes make up the bulk of returns in venture from, the singular companies. And there's a few of them, right? There's $15 billion exits created every year. I don't know if it's unicorns as valued in private markets or actual exits, but as we know, every couple of years, there's a company that comes along that's worth 10 billion. And every once a decade, there's a company that comes along that ends up being worth 100 billion. And the bulk of the returns in the entire venture landscape comes from those handful of companies. I think we end up focusing a lot on market metrics as the performance driver for venture returns. But the truth is, it's the performance driver for the mid-tier of venture returns. And that mid-tier venture returns is skating along at 2x multiple after 10 years, or 3x after 10, 2 to 2.5x after 10 years.
That's the top quartile.
Right. And so whatever it is, 1.8x, and now those guys are all underwater. So instead of being 1.8x, they're all going to return 0.7x or 0.5x, and they're going to lose money.
No, I think the 50th percentile returns money.
Okay. But the truth is, so now they're going to lose money. But the truth is, whichever funds get the tiger by the tail, whoever gets the Uber at 5 million, whoever gets the Slack at whatever you got in at, whoever gets the SpaceX at whatever Sachs got in at, you're going to be fine, because like the multiples in markets don't matter as much if you're generating 4,000x.
I don't think that's true. I don't think that's true, because if it happens in a fund and that all of those deals, except SpaceX, happened in a different valuation framework where rates were zero. So I think the more intellectually honest question is, what would Slack and Uber have gone public at today with a 5% 10-year? And I think the answer, if you're going to be intellectually honest, is a very different valuation than when it went out when the 10-year was zero.
It's going to be hard to make outsized returns unless and until the entry price is completely correct. And I think they've partially corrected, but they may not have fully corrected, because people, I think, always want to believe that there's going to be a bounce back.
Yeah.
And it takes time to kill that hope.
I think that might be the capitulation.
Capitulation is takes time.
I think that capitulation is starting to happen, to be honest. I mean, that was my observation. I feel like everything was so shut down last year, the start of this year, through the summer, and then in the fall, like just the last couple of months, it feels like there's this capitulation where it's like, okay, we're worth 80% less, but we need money. Let's do the deal. Okay, we'll put money in.
I don't think the reset can happen until Stripe goes public. I'll be very specific. I think that is the company that sets the cascading valuation framework for every other company. So I think all of this is a bunch of people, us blathering on and making stuff up. I think the true numerical forcing function, the clearing event, happens when they go public, because it will be, you won't be able to hide. Like I think we all would say, it's the best run company that's private. It's the most technical. It's gotten the most people. It's gotten the most pristine cap table. It's raised the most money it's done everything right.
It's the gold standard, yes.
And what their valuation is then what you can expect if you are of that caliber. Or you can expect a lower valuation if you are not of their caliber. And I think that until we know what that is, we're all going to be hoping, but we know that hope isn't a strategy. So my takeaway from all of this is just more that people have to really right-size the portfolio, sell what you can, find liquidity where there are people that want to buy at different entry prices. They may not be the price that you thought originally, but makes sense for them and their risk profile in this moment in time. All of this stuff has to happen to actively manage to exits, I think.
Well, and there's a new phenomenon that's going on that I've been seeing a lot of. I've been approached by a number of people who are buying strips of GP interest and strips of LP interest in venture funds. From the last 10 years, I got offered for a 5x on paper fund, like 3 point whatever X, and you could clear out, like you're saying, some of your shares. I got offered, half price basically, by some people who I think, I don't want to say they're bottom feeders, but I think they're maybe optimistic about certain names. And yeah.
I've noticed that the amount of activity from secondary brokers seems to have increased. And and specifically the emails that I get that are interesting are the ones where they're asking me to sell shares. So when someone's offering you, that doesn't mean anything, because there may not be any transactions clearing. But when they have definite buyer interest at a certain price, that tells you that the market now has found, or is in the process of finding, the market clearing price.
Yeah.
So I think we do actually know from the secondary market kind of where a lot of these unicorns are at. My guess is...
And what would you say on average? Half?
Yeah.
Half
I'd
price?
say there's a lot of half price.
That's what I see. I see a lot of half price action.
But that doesn't... I'm not trying to be a wet blanket, guys, but the average SaaS company that's public is down 75%. If you look at the fintech space, these companies are down 80 to 90%. So how can half be reasonable?